What if I told you the reason you feel behind financially isn't because you're lazy, undisciplined, or bad with money? What if the real reason is simpler and more uncomfortable? You were never taught the rules of the game you've been playing your entire adult life. At 18, you were handed a debit card, maybe a student loan agreement, and a cheerful welcome to adulthood. No class on credit, no breakdown of taxes, no explanation of investing, just vibes and fine print, lots of fine print. And here's the kicker. The system works perfectly for the people who understand it. For everyone else, it quietly extracts fees, interest, penalties, and missed opportunities. Not dramatically, not loudly, just slowly enough that you don't notice until 5 or 10 years have passed and you're wondering why you're still treading water. This isn't about blame. It's about leverage. Because once you understand the mechanics, the same system that drained you can start building you. Let's start with something almost invisible. Inflation. Imagine this. You check your bank account on a random Wednesday night. The number looks fine, about the same as last month. You're not overspending. You're not gambling. You're not making reckless purchases. And yet somehow, at the end of every year, it feels like you're not further ahead. That's because your money can lose value even when you do nothing wrong. Inflation is the steady increase in prices over time. It means every dollar buys slightly less than it used to. Over the last several years, cumulative inflation has significantly increased the cost of everyday goods. Groceries, rent, insurance, utilities, all quietly rising. If your money is sitting in a checking account earning close to zero interest, while inflation runs at 2 to 3% or more, your purchasing power is shrinking every single year. Think of it like this. Leaving excess cash in a low-interest account is like leaving an ice cube on the kitchen counter. It looks solid, stable, harmless, but come back in an hour. It's smaller. Not because you did anything wrong, because physics happened. Or in this case, economics. If you park $10,000 in an account earning 0.01%, while inflation averages 3%, over 10 years, you effectively lose thousands in purchasing power. The bank pays you a handful of dollars for the privilege of using your money. Meanwhile, they lend it out at much higher rates. You are subsidizing the bank. The bank is not helping you. The fix is simple but powerful. Keep 1 to 2 months of expenses in checking for cash flow. Everything else that is meant to stay liquid should move to a high-yield savings account, earning competitive interest. And money you won't need for 5 years or more? That should be invested. Which brings us to the most misunderstood force in personal finance. Compound interest. Compound interest is either your greatest ally or your most expensive enemy. There is no neutral. When you invest, you earn returns not just on your original money, but on the returns that money generates. Growth builds on growth. It starts slow, almost boring. The first few years don't look dramatic, but over time, the curve bends upward. Then steeper still. This is why time matters more than talent. Consider Warren Buffett. He began investing as a teenager. For decades, his net worth grew steadily, but not explosively. The majority of his wealth came later in life, not because he suddenly became smarter at 65, but because compounding had decades to do its work. If someone invests $300 a month starting at age 25, earning an average annual return of 8%, by retirement, they could accumulate hundreds of thousands. even over $1 million, depending on consistency and time horizon. But if they wait until 35 to start with the exact same contribution and return, the difference isn't small. It's enormous. Time inside the system matters more than the amount you start with. Now flip it. Credit card debt compounds too. At 20% interest, debt can double in roughly 3 to 4 years if left unchecked. Minimum payments feel manageable. They are designed to feel manageable. But mathematically, they stretch repayment over years and pile interest on top of interest. Carrying high-interest debt while investing modestly is like trying to fill a bathtub while the drain is wide open. You can pour water in all day. It won't matter if it's leaving faster than it arrives. The priority order matters. Eliminate high-interest debt first, then build, because a guaranteed 20% loss is worse than missing an 8% gain. Now let's tackle one of the most persistent myths in personal finance: tax brackets. Some people genuinely believe earning more money can cause them to take home less because they move into a higher tax bracket. That's not how progressive taxation works. In a progressive system, different portions of your income are taxed at different rates. Think of it like stacking buckets. The first portion fills at one rate. Once full, the next portion fills at a slightly higher rate. The income in the lower buckets never gets retaxed at the higher rate. If you receive a raise, only the additional dollars in the higher bracket are taxed at that higher percentage. You will always net more money when you earn more. Always. Refusing overtime or turning down a raise because of taxes is like declining a larger slice of cake because someone might take a small bite. You still end up with more cake. Understanding this changes how aggressively you negotiate salary, bonuses, and promotions. Fear keeps incomes stagnant. Knowledge removes that fear. Next, credit scores. 3 digits that can quietly cost or save you tens of thousands of dollars. Your credit score influences the interest rate on mortgages, auto loans, personal loans, and sometimes even insurance premiums. On a long-term mortgage, even a 1 or 2 percentage point difference in interest can translate into over $100,000 in additional payments over 30 years. And yet, many people don't understand what actually affects the score. Payment history is the single largest factor. Pay every bill on time. Every time. Even one missed payment can cause significant damage. Credit utilization, how much of your available credit you're using, is another major factor. Keeping utilization under 30% is generally recommended. Lower is better. Carrying a balance does not improve your score. That myth has cost people billions in unnecessary interest. You can pay your card in full every month and build excellent credit. Checking your own score does not hurt it. That's a soft inquiry. The system expects you to monitor your own financial data. Errors on credit reports are more common than people think. Reviewing your report annually is one of the highest return tasks you can do in under an hour. Now let's zoom out and talk about debt in general. Not all debt is equal. Some debt builds earning power or long-term value. Some debt erodes both. A mortgage on a property that appreciates over time can build equity. A student loan tied to a degree that substantially increases lifetime income may be an investment. But high-interest consumer debt tied to depreciating assets? That's wealth extraction. A luxury car loan stretched over 7 years means you're paying interest on something losing value daily. Credit card debt from vacations already taken is paying tomorrow for yesterday. The test is simple. Does this debt increase my net worth or earning capacity over time? Or does it drain it? If you're currently in debt, strategy matters. The avalanche method, paying highest interest rates first, minimizes total cost. The snowball method, paying smallest balances first, builds psychological momentum. Mathematically, avalanche wins. Behaviorally, snowball often wins. The best strategy is the one you will actually execute consistently. Now let's talk about the emergency fund, the most boring, most powerful financial buffer you can build. Nearly half of adults would struggle to cover a $1,000 unexpected expense without borrowing. That's not irresponsibility. That's lack of margin. When an emergency hits without savings, the solution becomes high-interest debt. A car repair turns into years of minimum payments. A medical bill becomes a lingering balance. An emergency fund is a financial circuit breaker. It prevents small problems from escalating into long-term setbacks. Start with $1,000. Then aim for 3 to 6 months of essential expenses. Keep it separate from daily spending. It's not for vacations, not for sales, not for upgrades. It's for true emergencies. The psychological shift alone, knowing a surprise expense won't derail you, changes how you approach money. It replaces panic with control. Now let's talk about opportunity cost. Every dollar you spend has 2 price tags. The visible one, what it costs today, and the invisible one, what it could have become if invested instead. That $200 monthly subscription bundle you barely use? Invested at 8% over 30 years, it could grow into hundreds of thousands of dollars. This doesn't mean eliminate joy. It means be intentional. If you love something and use it daily, keep it. If it's autopilot spending, reconsider it. Small leaks sink ships. Most wealth isn't lost in dramatic splurges. It's lost in quiet, recurring transactions no one questions. Now we reach the core strategy most people overcomplicate: investing. Stock picking is seductive. It feels smart, active, strategic. But data consistently shows that the majority of professional fund managers fail to outperform broad market indexes over long periods after fees. Low-cost index funds provide diversified exposure across hundreds or thousands of companies. Instead of betting on one winner, you own the market. Consistency beats prediction. Automation beats emotion. If your employer offers a 401k with a match, contributing enough to capture the full match is one of the highest return decisions available. It's an immediate return on your money before market growth even begins. Beyond that, tax-advantaged accounts like a Roth IRA allow after-tax contributions to grow tax-free. Paying taxes on the seed instead of the harvest can dramatically reduce future tax burden. The strategy is almost boring in its simplicity. Contribute regularly, choose low-cost diversified funds, automate contributions, and avoid tinkering. The hardest part isn't selecting investments. It's staying invested during volatility. Markets rise and fall. Headlines panic. Fear spikes. The investors who build wealth are not the ones who predict crashes perfectly. They're the ones who remain consistent across decades. Now let's address lifestyle inflation, the silent thief of raises. You get promoted. Income increases. You upgrade your apartment. Lease a nicer car. Eat out more often. Buy higher quality everything. None of it feels irresponsible. It feels deserved. 6 months later, your bank balance feels exactly as tight as before the raise. Psychologists call this